And you can either see a recorded version of this class by using the same link you used to come to tonight's class, or in a short while, you can see an edited version by going to investing.com and looking under the Education tab, and you can see all our webinars there. You can see all of our past webinars also. Now, because Alvexo is a regulated provider, I need to provide you this risk warning. This webinar is considered a marketing communication that does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or a solicitation. Alvexo makes no representation and assumes no liability as to the accuracy or completeness or the validity of the timeliness of the information provided. Furthermore, this material has not been prepared in accordance with legal requirements promoting independent investment research. This webinar provides personal opinions and experiences. Those are my opinions and experiences from my 40 years of trading and my 15 years of teaching. Provides information generally available to the public, does not provide investment or trading advice or recommendation, does not intend to address individual circumstances or objectives, and may include examples of trading activities. So let's get started talking about divergence. Now, to begin with, there's a handout I prepared for you, and you can see it on your screen, and you can click on the download button and download it now to whatever device you're using, because it's only available in the live class. Also tonight, I'm going to share a presentation with you. If you wish to see that presentation, again, you can go to the link I just propped up on your screen and watch the video I'm putting that's up there on trading divergence and RSI. But I'm going to show it to you later in this class. Now, in the Forex markets, or for that matter, even in futures, stocks, cryptocurrencies, and commodities, divergence is often related to the price and the oscillator that is tracking the prices. Now, the fact is, divergence has nothing to do with the oscillator or indicator you're using, whether you're using RSI, MACD, stochastic, CCI, Williams R, whatever your indicator that you're using, divergence is between the price and the movement on that particular indicator. Now, it is most widely used with MACD and RSI or stochastics. Okay. So an oscillator is used to track the overbought and oversold prices, because most of the oscillators are based on price and the relative momentum or volume. Oscillators are the best choice for understanding momentum in prices, which signal how strong or prevailing the trend is. Now, divergence can only occur between those oscillators indicators that are put on the bottom of your chart. Like, you don't have divergence using moving averages. You don't have divergence using Bollinger Bands, which is put over price action. You don't have divergence really in volume. So it's only those, and that's most of the indicators that are dropped on your charts below the charts. When prices reverse or retrace, the oscillator tends to follow the same pattern. Therefore, when prices are making higher highs and higher lows, the oscillator tends to mimic those same patterns. So let me take you over to a live chart and show you this. Okay, so we're looking at a chart for Bitcoin. Irrelevant. It's got nothing to do with the price of Bitcoin. It's about what you can see on here. So as we look at the price of Bitcoin on this chart, okay, we can see that the oscillator, in this case is RSI, moves into basically the same patterns as the price does. Divergence occurs when the oscillator is moving in one direction and price is moving in the other direction. Okay. So in this case, we don't see any direct divergence because everything seems to be moving in the same direction, because it's not all that often that we get divergence. But when divergence occurs, we can then use it in our trading. So we can go over to another chart I got prepared for us. And here, let me just clean up these markings. We can see divergence. Okay, because at this point we have price moving up and the oscillator is moving downward. So imagine you're simply drawing a trend line on prices and you're drawing a trend line or connecting the points on the oscillator. So when the oscillator is making lower lows and the price is making higher highs, they are diverging from one another. They're moving in the opposite direction. And there are several different types of divergence. So this is showing what we call hidden bullish divergence. We have bearish divergence, bullish divergence, and then we have hidden bullish and hidden bearish. So there's 4 different types of divergence. But basically, they are all follow the same rule. Price moving one way while the oscillator is working or indicating in the other direction. So when the oscillator is making lower lows and the price is making higher highs, so in other words, you have an uptrend and a downtrend, they are diverging. That's what the word diverging means. So let's go back to my PowerPoint. When price reverses and retraces, the oscillator tends to follow the same pattern. Therefore, when prices are making higher highs or higher lows, the oscillator tends to mimic the same pattern. Conversely, when prices are making lower lows and lower highs and lower lows, the oscillator tends to print the corresponding lower highs and lower lows. Now, remember, the definition of a trend, an uptrend is defined by making higher highs and higher lows, because an uptrend goes like this: push, ease, push, ease, push, ease. So it's making a higher high, then it's making a higher low, and that's higher than the previous low. Higher high, higher lower. In a downtrend, you have the exact opposite. You're making lower lows and lower highs. So when price makes a higher low and the oscillator fails to confirm the same, it is known as divergence. By spotting these divergences, traders are usually signaled to a potential change in the direction of price. Now, seems very simple, but spotting them and interpreting them is is a little bit more complex. I've given you the handout where I've given you charts and examples so that you can see how to interpret or how to locate and how to use divergence. So you don't have to memorize everything I'm saying tonight because it's in the handout. Divergences are formed when there is a mismatch between the price action and the momentum, measured by the oscillator relative to the price. Quite often you will notice that divergences tend to occur near support and resistance levels. This is something very unusual, but when it happens, or why it happens, or when it forms, is very crucial. You should see it near that support or resistance level. Therefore, divergence trading can be used not only to time the entry into a trade within a trend, but it can also help you to understand support and resistance levels. Now, while divergences are broadly classified into 4 types, the underlying theme among the 4 types of divergence is that it shows price exhaustion when the oscillator fails to confirm the new high or the new low. Divergences take place all the time across all the time frames. However, the best results come when divergence is spotted on higher time frames, such as 4-hour sessions and higher. One of the most common mistakes one often made with divergence trading is that traders expect the price to behave in a certain way when divergence is spotted. This is wrong. Just because a divergence is formed doesn't mean that price will reverse. Now, in the charts that are outlined that I'm going to show you later, or that it is in the article, the GAN that I hand you, you will find a few divergence setups where price moved in the opposite direction, contrary to what the divergence was telling you. It is therefore important to understand that traders should look at confirmation tools, which will be also covered later in tonight's class, before trading the divergence setups. Now, there are 4 types of divergence. We have regular and classic divergence and hidden divergence. And on these, each of the categories have 2. We have regular bullish divergence and regular bearish divergence, which we just call bullish and bearish divergence. And then we have hidden bullish and hidden bearish divergence. Okay, and this is what they look like. Okay. Now, when you're looking at plain old-fashioned bearish divergence and bullish, they're very easy to spot. Okay. Price is moving up, oscillators moving down. Price is moving down, oscillators moving up. Now, doesn't look all that much different in the hidden bearish and hidden bullish, does it? Okay. It really depends on where it falls within the wave of the trend. So when price is moving from high to higher highs, and the oscillator moves from high to lower highs, this is regular bearish divergence. Or lower lows and lower highs, and then lower lows and then higher lows, is regular bullish divergence. A hidden divergence is when we have price moving in a high to a lower high, and the oscillator moving from a high to a higher high, which is kind of hidden, and then low to a higher low, while the oscillator is moving low to lower high. That's a lot of words that it's hard to grasp and see. But if you look at the difference between bearish and hidden bearish, here the oscillator is making a high and a lower high. In this case, in the hidden divergence, the oscillator is making a higher high. Where in the same thing with bullish, price is making lower low and then a lower low, while the oscillator is making a low and a higher low. So basically, it's just simply 4 combinations of the possible higher high, higher low scenarios. And to be honest with you, I don't even know why they call it hidden. We could just call it alternate. So a regular divergence is used as a possible sign of a trend pause or a trend reversal. A regular bullish divergence occurs when the price makes lower lows, but the oscillator is making higher lows. Usually this happens at the end of a downtrend. Price and momentum are expected to move in line with each other. If price makes a new low, but the oscillator fails to make such a new low itself, it is likely that the price will retrace and even reverse. And it's got nothing to do with the 80-20 or the 30-70 bullish and bear, overbought and oversold indicators of RSI and stochastics. It's simply between a trend line, a line drawn on the movement of the oscillator. So it doesn't matter if that oscillator is moving from 30 to 32 to 34 and staying dead center or the bottom half of the middle of the, doesn't make a difference. It makes a difference on the angle in which it is moving when it's moving against the trend of the price. And so bullish divergence or bearish divergence is just the exact opposite of bullish variance. There's one for either direction. So it's coming off of a downtrend and an uptrend. So in this case, we see that price is forming lower lows, and here we have we can connect it together to form this trend line. Where the indicator, in this case is MACD, is moving up, making higher highs. In other words, it's moved the exact opposite of price on the indicator. It's got nothing to do with the numeric values of the histogram, and it's got nothing to do with the actual price of the assets. It's the direction of the movement. It's simply the lines. So divergence and convergence can be used in a multiples of manners. When the currency is diverging, the likelihood of the trend continuation is decreasing and a trend reversal is possible. When the currency is converging, the likelihood of a trend continuation is high and trend reversal is unlikely. The oscillator indicates to us that momentum is possibly shifting. And even though the price has made a new peak or bottom, the chances of the momentum being sustained and continue are decreasing. Regular divergence is useful for cautiously predicting the end of a trend, but only when, in some cases, when the currency pair or the asset totally reverses for the trend in the opposite direction. Now, the name of this pattern speaks of its character. We have a divergence when the price momentum is contrary to the indicator. And I keep reinforcing that because people always want me to either tell them what indicator or what price or what, they're so stuck on, stochastics being above 70 and below 30 that they want to say what number. It has nothing to do with numeric value. It is simply the character or the trend or the movement. That is it. And the harder the divergence, if the price is moving in a well-developed uptrend and the indicator is moved to a well-developed downtrend, you have a much better chance of having a strong divergence move or a strong trend reversal. So the following charts will show you some examples of bullish and bearish divergence. Okay. So these are also in your handouts, but here it's relatively easy to spot. Okay. Here we have price moving down. And what do we have? We have the indicator moving upward. So therefore, we have regular bullish divergence. Here, a previous case, we have price moving upward while our stochastics indicator is moving down. Okay, it's not falling. It's got nothing to do with the fact it fell. It's the highs. So here we're making higher highs, while here we're making lower highs. Okay, it's moving in the opposite direction. And again, this is regular bearish divergence. Why is it bearish? Because it's telling us that movement should turn downward, become bearish. Here, it's bullish because it's telling us that movement should move into a bullish move or upward move or uptrend. Okay. Again here, now we have hidden divergence. Okay. So we can connect and we can draw a trend line, and it's a line that's a trend, but it's not following the rules of a trend line. A trend line says you have to have 2 points in common, it has to have a third point to validate. So we could draw a line that would tell us the characteristic or the trending pattern of the price. While here, we have outstanding bearish, bullish divergence. Again here, and here. And if we come over to this chart, again, can you spot it? I've got them all set up for you, but they're easy to spot. But if you notice, I didn't tell you anything about the relative value of the indicator below, and I barely mentioned to you what indicator it is because it doesn't make a difference which indicator you're using. Now, later, we're going to talk about some strategies using RSI and MACD because they are two popular indicators that work very well with divergence, but those are specific strategies for those indicators. So spotting divergence takes time. It does not expect, so don't expect results overnight. The best way to get started with spotting divergence is to use one of the many custom divergence indicators. These automated indicators spot the divergence for you, which can act as a good starting point to understand the highs and lows. In terms of which oscillators to use, RSI makes the ideal oscillator to train your eye to spot the divergence. Okay, so here we have RSI on the bottom of our chart as our indicator. We're using the standard RSI 13. And here we can see RSI is falling, making lower lows, while price is making higher highs. What's happened is this indicator has moved. It's not the trend line, like I said, it's not the trend line that you're putting on price. It's the overall character of the move. And what we can see here is we can see up and we can see down. Here we can see a price movement up while the indicator is moving down. And the indicator, though, should be following the same movement of price. When it doesn't, that's why we call it divergence. And believe me, it's easy for me to put these on long-term charts and give you examples. Seeing it in live trading isn't so fast and so easy. So you have to learn how to find it and learn how to train yourself to how to to locate it fast enough and use it properly. Because locating it, it's easy to look at it when it's happened hours before or days before. An example I'm using. Okay, it's harder to find it in actual, because you can only trade at the wall here. So finding divergence back here isn't going to do you much good. So there's other methods of confirming divergence. The one method of analyzing divergence from a different perspective is by using trend lines and trend channels. Once divergence occurs in the market, a single line trend line can identify when a trend is ending and may signal the end of a trend. Waiting for the break could be one way of trading divergence. Similar trend lines can also be used on the momentum indicators themselves, using the same spots in time and price action. The momentum trend lines, will be useful in identifying and spotting reversals and trend breaks. Another important point is by managing expectations with regards to divergence. There is a substantial difference between the pip size of a reversal and a retracement. Be careful to reckon and plan on both in your trading. One way of distinguishing between the two is by looking at time frame. If a trader is observing a 15-minute or 1-hour divergence, and the divergence will most likely create a pause or retrace within a bigger trend continuation. If a higher time frame has divergence, the likelihood of a trend reversal is higher. Basically, the higher the time frame, the more powerful, as you can see in the example of the euro-US dollar. Okay, I'm sorry, I don't have the chart up here, but the chart is in your. Sorry about that. Okay, I'm sorry, my computer skipped a couple frames. I had to go back here. Okay, while regular divergence is especially useful for cautiously predicting the end of a trend, hidden divergence can be a good indication of a trend continuation. So one's telling us an end of a trend and the other's telling us a continuation. Hidden bullish divergence takes place when the price is making higher lows, but the oscillator is showing a lower low. In an uptrend, hidden divergence happens when price makes a higher low, but the oscillator makes a lower low. Hidden bearish divergence occurs when price makes a lower high, but the oscillator is making a higher high. Since we discussed the 4 types of divergence patterns, we'll now talk about the importance of the divergence indicator. As I said, you need an indicator on your charts in order to discover divergence. The reason for that is the price has to be in a divergence with something. It's simply impossible to trade divergence without having an extra indicator on your charts. So the question becomes, which indicator or indicators are best for divergence trading? Well, let's find out. Now remember, we have discussed the types of divergent patterns and some reliable indicators to spot divergence with. And I've mentioned to you RSI and MACD, and we're going to get to those in a minute. But it's important to understand that we have to always use money management when trading divergence. However, before you start trading divergence setups, there are a few more points which we need to discuss. These things include an example money management approach, and example money when trading divergence setups. If you do not have a sound money management plan, you are likely to lose money trading divergence or any other setup for that matter. Regardless of your trading method, you should always use a stop loss to protect your risk. It is no different when you trade divergence, and for most traders, it is best to place a hard stop in the market instead of using a mental stop. So as far as divergence setups go, one way to place your stop loss would be to put it right at the last top on your charts, which confirms the bearish divergence. If the divergence is bullish, then we rely on the bottoms, and the stop should be placed below the last bottom on the chart. But remember, money management and risk management, none of these indicators, none of these strategies, none of these ways of trading are guaranteed profits. They're just help. So it's always important that you always use money management, risk management, and stop losses. It's very, very important. Now you can see on this chart where you would determine your stop loss. Okay, so you can just place that stop loss at the bottom of the candle right before it the breakout into the uptrend. And see, we have the divergence down below where we have higher bottoms. We have lower bottoms on the top. We use other indicators to tell us to trade. And we would enter as the part moves up and use that point of divergence, the lowest candle, to place your stop loss. You should also have a strict take profit rule when trading divergence. For all the positive of trading divergence, one of the things that divergence does not offer us are clear targets. Therefore, an additional tool should be used in order to select your profit targets, because you need to figure out your profit target and your take profit point and when you're going to exit the market. But you also need that to calculate your risk and your profit reward ratio to see if you can even afford to make that trade based on your own risk money management. Typically, if you trade divergence with RSI or stochastics, you may need an additional indicator to close your trades. However, if you use MACD, then you could fully rely on this indicator alone. The reason for this is that MACD is a lagging indicator, and it is a good standalone tool for exits as well as entries. My preferred method is using swing analysis and support and resistance levels for trade management and profit target setting. However, as I have just mentioned, the MACD is a very viable option. MACD happens to be my favorite indicator. If you ever attended one of my classes on MACD, you'll see that that is my gospel. I love MACD. So we can see on MACD here, down below, we have the histogram. We have the MACD slow line, the fast D line, sometimes referred to as the MACD line and the trigger line. And we get the entry signals when the MACD line and the trigger line cross over. But we also get divergence. When we get divergence and they get a crossover, it's a great time to trade. So we all have tools that we need in order to put a Forex divergence trading plan together. So let's now combine all the rules and see how this would look. We will use the MACD indicator for spotting divergence and for closing trades. When we see discrepancy between price action and MACD, we will enter trades based on a divergence signal. When we see a MACD crossover in the opposite direction, we will close out our trades. And I believe this, in detail, it's on your handout. But as you can see here on the chart, I'm just trying to get my markers on for you. Okay. Here we have price making lower lows, and it's running in a downward motion, while our indicator is running in an upward motion. Okay, so we have divergence. Now we get also at the same time, this is the point, the entry point that's giving us when we have the crossover between the MACD line and the MACD trigger line, the red and the blue line, and that's telling us, giving us a buy point. So it's telling us to enter the market here going long. We would enter long, we would place our stop loss at the bottom of the lowest candle at the point of the divergence, and we would look for our close point, where we would close our trade when MACD crossed over the signal line and the MACD line, the MACD line and signal line crossed over in the opposite direction. So here we go, here we go, here we go. And that's the whole MACD strategy in a nutshell. It's not that complicated. You need to practice to get it down pat because there's more to it. So we first start by spotting a bullish divergence between the MACD and the price action. The chart shows lower bottoms while the bottoms on the MACD are increasing. That's what we saw here. Suddenly, after creating its third high bottom, the MACD line makes a bullish crossover. We could use this signal to go long on our bullish divergence setup, as shown in the green horizontal arrow here. The price starts moving upward, the MACD starts increasing as well. 2 months later, and because this is a monthly chart, 2 months later, the MACD signals a bearish crossover. We use this as an exit signal and we close our trade. Okay. Now, this is a longer term trade. It still applies the same because most of us here are CFD traders, and so therefore we're day traders. So a complete divergence strategy using MACD. So we have discussed various types of divergence. You have to learn this, and you're not going to learn it in a 15-minute presentation, or a 10-minute talk right now about MACD. Okay. Then there's RSI and divergence, which is extremely popular. And I prepared a presentation for you on that tonight. But divergence works well on all indicators. But my favorite by far in just divergence is RSI. The RSI compares the average gain and average losses over a certain period. So, for example, if your RSI is set to 14, it compares the bullish candles and the bearish candles over the last 14 candles. When the RSI value is low, it means that there were more and stronger bearish candles and bullish candles over the past 14 candles. And when the RSI is high, it means that there were more and larger bullish candles over the last 14 periods. So RSI is placed on the bottom of our chart, and we can see divergence exactly the same. Because again, it doesn't matter what indicator. You're looking for the indicator to be moving in the opposite direction of the price chart. So here we have an upward sloping indicator with a downward sloping price movement. So I prepared a little presentation for you, which I'll share with you. I'm going to pop it up on your screen, that is going to show you some examples of divergence and MACD. So let me pop that up here for you. So as I explained to you, it's very easy to see past divergences, but it really comes down to is seeing them at the wall and being able to use them in your trading. So here on the screen chart shot, I have, okay, let's get this back again. Okay, here on the screenshot, you see the same euro pound, and now we've moved up to the end where price was currently trading. Now what we see price moving up, but the indicator moving downward. That's telling us this uptrend is about to end. And you can see here as it peaked, price then bounced off and price moved into a very strong downtrend, or started to move in a downtrend, and we would be entering a short position from there. Okay, you need to use other tools to decide how far it's going to go, where to put your stop loss and your take profit points. Okay, you should be looking at support and resistance on your chart to make a final determination. But we can also go back and look at RSI, and it was way up here in the overbought zone. Not only was it diverging, at this point it was in the overbought zone. Here, a peak back into overbought zone, telling us that price is about to fall. We have the divergence, and it's giving us an indication to short that asset. So a classical technical analysis tells us that a trend exists when price makes higher highs. But like too often, conventional wisdom is seldom right and usually simplifies things too much. A trader who only relies on highs and lows for his price analysis often misses the most important clues. Even though the trend could look healthy at first glance, it might be losing momentum at the same time when we look deeper at the candles and the momentum. And that's kind of what divergence tells you, is that the asset or the current move is losing its momentum. Okay. Now I'm a pure reversal trader, and I look for early trend trades after divergence, and these are my bread and butter. Especially, I look for simple trading strategies, and I look for simple entry and exit points because I'm more about risk management and money management. Okay. And divergence is a great way to help. So divergence does not always lead to a strong reversal, and often price just enters a sideways consolidation after divergence. Keep in mind that a divergence just signals a loss of momentum. So imagine you've shot up a rocket into the air. Okay, you know it can't go up forever, or say a firework. Okay, but you're on the ground and you see that rocket going up and up and up, and it's hard to calculate how much further it's going to go. But you know at some point it's going to tip over and come back down to earth. Okay. But it's hard to, from down on earth, to see that it's losing its momentum, its speed, its strength. But if you could calculate that, and if I were to tell you that based on wind trajectory and gravity and everything else, at 422 feet, it's going to start losing its speed going upward, and at 472 feet, it's going to flip over. Okay, well, those are all calculations. Well, divergence kind of tells us when the price movement is getting losing its momentum. It doesn't tell us at what point it's going to actually flip over. But when you can tell that it's losing momentum and a trend is about to shift, it's giving you a lot of information. To avoid trade entries that don't go anywhere, I highly suggest you add other criteria and confirmation tools to your arsenal. A divergence alone is not something that's strong enough, and many traders experience bad results when trading only with divergence. It's one of the reasons MACD is such a great indicator. Because see, MACD tells us three stories, because we have the histogram, we have the MACD line and the MACD signal line, and MACD gives us three different scenarios that we can use. So we have our overbought and oversold indicator in there, we have a momentum indicator, and we have a transaction indicator. So we have everything combined into that MACD. Okay. So just like any trading strategy, you need to add more confluent factors to make your strategy stronger. Location of an optimal entry point is a universal concept in trading, and regardless of your trading system, adding the filter of location can usually always enhance the quality of your trades. Instead of taking trades just based on divergence signal, you'd wait for a price to move into a previous support and resistance zone, and only then look for divergence and trend shifts at that time. So here on the left side, you see an uptrend with two divergences. However, the first one completely failed, and the second one resulted in a massive winner. What's the difference? Well, when we take a look at the higher time frame on the right, we see that the first divergence happened in the middle of nowhere, and the second divergence formed at a very important resistance level. As a trader, you first identify your support and resistance zones and then let price come to you. Such an approach will impact your performance in a big way. So don't chase the divergence. Use your standard. To me, first thing you do is you draw a trend line. Second thing you do is you put your support and resistance level, whether you're trading the asset or not. Every asset I follow, I'm putting my support and resistance levels on there all the time, because I am a support and resistance trader. Okay, I firmly believe in those price levels, and then when I see price approaching one of those, I look for other confirmation signals. So divergence can help you, but divergence when it's in the middle of nowhere and just in the middle of a trend doesn't really tell you anything on its own. So a divergence setup is a leading pattern giving us an early entry into an emerging price move. Divergence trading is an effective method and allows traders to combine price action and indicator analysis into a trading strategy. So remember, there's 4 types of divergence: bullish divergence, bearish divergence, hidden bullish, and hidden bearish. Some of the most reliable indicators for trading divergence are MACD, RSI, stochastics, momentum, and Bollinger Bands. A sound money management plan is required for trading Forex or any asset divergence for any strategy for that matter. Divergence signals do not provide clear profit targets. We do not know how far prices are likely to go once they reverse. So in many cases, we have to utilize other techniques to exit our divergence trade setups. The MACD is a good standalone tool for trading Forex divergence. When you trade divergence with MACD, it can be used to provide you with entry and exit signals, or what we call transaction signals. So it's important to remember that most trading approaches reliant upon divergence are based upon the correlation between momentum oscillators and the individual security's price action. In the event that a security is in the midst of a strong trend, momentum oscillators can give false counter-trend signals. Conversely, when the market enters a consolidation phase, the lack of sufficient price action may lead to scarcity of clear-cut signals. Being aware of the current market state is imperative to a trader incorporating divergence into their trading approach. Ultimately, divergence is best utilized as a tool for confirmation, and it should be used to make trading decisions in concert with other aspects of technical and fundamental analysis. Any opinions, news, research, analysis, prices, or other information, or links to third-party sites are provided as general market commentary and do not constitute investment advice. So remember, we're just trying tonight to educate you and not to give you, that's why we were using assets that, are not important, because we don't want you to mix this up with a trading advice or investment advice. We're trying to educate you so that you can come up with the best signals and trading possible. And remember, always use risk management and money management. So have a very good night now, and thank you very much for joining us, and we'll talk to you again real soon. Okay, and if you want to see that presentation again, that little thing on RSI and price movement, I've given you the link again where you can find that. So thank you very much.